This is Money Exchange with Andrew Barnett.
Hello, I'm Andrew Barnett and welcome to Money Exchange, the only TV program dedicated to keeping you up to date on everything you need to know about currency markets. Well, you've been hearing it here for weeks and we've finally got the follow through we needed. Some genuine downward pressure and momentum is once again starting to build on the Aussie and Kiwi dollars, as well as the euro. And some strong momentum is once again rallying the US dollar after the US Federal Reserve signalled on Thursday morning December is the month they'll likely begin to raise interest rates for the first time in nearly 10 years. Tonight on the program, I'll be telling you where I think the major currencies are headed in November and December and next year, and what central banks are likely going to do with interest rates and which of them is gearing up to print more money and devalue their currency. Shortly, we'll cross to Singapore to speak with Head of Asia Pacific Research at TD Securities, Annette, who's accurately predicted what the RBA and RBNZ would do with interest rates in September and October. Can she get it right again in November and December? And does she still hold the view the Aussie dollar will be at 68 cents by Christmas? We'll also cross to Melbourne to speak with a trader who made over 100% return on investment in the past 12 months whilst living the dream in Thailand. What's his secret? Stick around, we'll endeavour to find out. But first, let's take a look at this week's headlines. The Bank of Japan is holding fire on new stimulus for the economy despite a recent round of weak data that sees the country on edge of recession. The Bank of Japan has kept its annual asset buying scheme at its record 80 trillion yen level. The decision was made by an 8-to-1 vote, with only bank member Kyuchi voting against keeping policy steady. The US Federal Reserve left interest rates unchanged at zero this week, but it did leave the door open to the possibility of a hike at its next meeting in December. The Fed cited steady labour markets and moderate growth in the US economy. But inflation remains exceptionally low, with the greenback continuing to gather strength amid easy monetary policy from other central banks around the world. Export prices came in flat for the September quarter, missing analyst forecasts. It brings the yearly decline in export prices to 5.2%. as commodity prices weakness takes its toll. Meantime, import prices rose 1.4% in the quarter due to the impact of the falling Australian dollar. Import prices have now risen 3.5% in the year to date. The Aussie dollar moved sharply lower on the back of weaker than expected inflation data on Wednesday, and this has put the pressure back on the RBA to consider another interest rate cut in coming months. The RBNZ didn't hold back on Thursday, saying its statement, and they're likely going to drop rates again, again. Joining us over the phone from Singapore to chat about both central banks and their currencies is Annette, Head of Research at TD Securities. Hi, Annette.
Hi there, Andrew. Happy Friday.
And to you too. Annette, you've accurately predicted the rates on hold stance from both central banks in the past couple of months. We're all keen to know your thoughts on whether or not we're going to see any further rate cuts from the RBA or RBNZ before Christmas. What are your thoughts?
Well, the funny part is everyone is expecting action from both, even though the last thing we heard from the RBA is they are staunchly neutral, which of course means the next move could be up or down. But of course, financial markets aren't listening to what they said yesterday. They're obviously trying to predict what they're going to do for next week. And the big difference between last month, the last meeting, and next week, of course, is we did see those out-of-cycle mortgage increases from the major banks, so that's new news. And secondly, we had that shockingly weak CPI. We were all expecting underlying inflation to rise 0.5 or 6%, and instead we only got 0.3. So the market's gone from pricing maybe a cut next year to maybe a cut ready for Santa Claus's visit. My view, I think the RBA will stand tight, particularly those increases in mortgage rates are actually, you should not think of them as monetary policy, you should think of them as a way for banks to shore up their financial strength. As you know, the banks are borrowing and raising capital and debt to shore up their capital, and increasing the price of mortgages is great for financial stability down the road. We should not tangle that up with monetary policy. And secondly, yes, weak inflation. I cannot deny that that number is a lot lower than anyone expected. We have annual inflation running at 2.2. The RBA thought it should be 2.4. So what does it do next week? It tells us it's very comfortable with the inflation outlook, but let's leave the powder dry and see what 2016 brings, especially let's see what the Fed does with interest rates. Long-winded way of saying the RBA will acknowledge everything that I've just discussed, but leave the cash rate at 2%.
Okay, so I know you predicted here on the program a few weeks ago that the Aussie dollar will finish closer to 68 cents before Christmas. Do you still hold that view now, Annette?
I don't. Circumstances have changed, and therefore I've also changed my mind. We actually lifted that target from 68 to 71, which is actually where we are now. The reason that's the case is the market has priced in a rate cut by year end, and I just don't see that happening from the RBA. And in terms of the Fed, we do expect the Fed to increase interest rates, but not until early next year. But that doesn't mean that we see some better US dollar strength. So in amongst that, China is slowing, commodities are lackluster, not falling out of bed, don't get me wrong. You put all that together, and I think all that just leaves us where we are now, which is 71 cents.
Okay, so no rate cut next week, 71 cents. Very quickly, Annette, across the ditch, RBNZ, Graham Wheeler, is he going to drop rates before Christmas, and can we see the Kiwi dollar perhaps lower?
Oh, the Kiwi dollar is on a tear this week. Wheeler managed to bugger up which was actually a pretty clear call, which is, look, we're not going to cut right now. He did say in a speech about 10 days ago that he was keeping his powder dry for whatever next year brings. I think that's a very sensible decision. But what he should have said this week was, look, we're not cutting now, but I think we need to cut soon because we do have a terms of trade shock, and that will dampen the economy. Unfortunately, he didn't put in the usual phrase. The FX market loves to look for phrases, and he left out the phrase that said further depreciation is appropriate or necessary. So Kiwi dollar has outperformed all this week, left the Aussie dollar behind. It's currently at 67 cents. So we need to see some softer tones or some action from Graham Wheeler, and we are looking for a Santa cut from there across the ditch.
Annette, as always, thanks so much for your time.
Thanks, Andrew.
After the break, we'll cross to Melbourne to find out what's the secret sauce in Thailand that's helped this trader make over 100% return on investment. Don't go away.